afternoon. Thank you so much for joining us. My name is Alicia Field, and I'm the Director of Events at the Greater Reston Chamber of Commerce. And we definitely appreciate you joining us for today's Business Success webinar series, Retirement Plans and How the CARES Act Impacts Employers and their Employees' 401k Plans. So before we get started, I'd like to quickly recognize our sponsors who you'll see here on our screen. Here are our strategic sponsors. It's covered up there, but Leidos is right behind our cameras there. Also our visionary sponsors, as well as our advocate sponsors. I'd also like to thank our founding sponsors of this webinar series. We've got BEI, as well as Reston Community Center. And we've both got representatives from both organizations here today. And from BEI, we're joined by Ellen Jennings, the CEO of BEI, to say a few words. Ellen?
Thank you, Alicia. Great to be here today, and I'm looking forward to listening to the webinar. BEI is an IT support company. We provide IT support for small and medium-sized businesses throughout the Metro DC area, and one of our longtime clients is the Reston Chamber. We very much embrace the greater Reston area and all the members of that community. We focus on two areas that are pretty relevant right now, and one is, they both kind of are around compliance. So for the healthcare industry, that's HIPAA. For the GovCons, that's something called CMMC, which is an emerging standard. We've been really focused lately with our clients on the issue of security, because with everyone working from home, there's all sorts of new issues that are introduced. And we always remind people that bad guys thrive in bad times. These are in many ways bad times. So there's a lot of hackers, a lot of malware, a lot of phishing going on. So we're really encouraging everyone to be careful, and take advantage of things like online training. We do fake phishing campaigns for our clients. We send out weekly sort of security tips. So anyway, with that, I'd like to turn it over to Lila.
Great, thank you so much, Ellen. Lila?
Thanks, Ellen. Thanks, Alicia. It's great to be with you again today. Reston Community Center is Reston's full-service recreational, leisure time, and cultural pursuit agency. We are presently closed, our facilities, but we have a robust series of virtual online offerings at the Reston Community Center YouTube channel. Just Google us on YouTube, or search for us, I guess. And in addition to that, we just want to remind employers that your employees are treated just the same way we treat Reston residents with respect to early registration privileges for our programs and offerings, and reduced pricing, significantly reduced pricing for our programs and offerings. And we love having employees, whether they live in Reston, participate as part of the Reston experience that we offer. I urge everybody to go to restoncommunitycenter.com to stay tuned for when we will be reopening. We're pointing toward a July 6th reopening date. We will have a limited schedule of some summer camp offerings in place at our two facilities. And with public health guidance and social distancing and all the kinds of things we're all practicing to keep each other safe, we're looking forward to having people back in our environments again soon. So thanks so much for letting us participate in these great webinars, and we wish everybody great success and wellness.
It's our pleasure. Thank you so much, Lila, and thank you, Ellen. Thank you to both of your organizations for your assistance in making these possible. Really appreciate it. So other than that, without further ado, I'd love to welcome our presenter, Bradley Troy, who is a wealth management advisor with First Financial Group, and he's joining us today to provide guidance on 401k plans during this time. So Bradley, please take it away.
Thank you very much. The content is helpful, and so that's really our ultimate intent, is to help as much as we possibly can. So my name is on this front slide. My name is Bradley Troy. I'm a financial advisor with this organization, First Financial Group. We're a large regional financial planning organization, but 30 years ago when I joined the firm, I started the process of building a practice that is focused on working with businesses that are nonprofit or for-profit in specifically the retirement plan space. So 401ks and 403bs and 457s and all that kind of stuff. And so for our organization, which has offices from Virginia Beach to Philadelphia, I run this fiduciary advisory consulting practice. I'm not a third-party administrator. I'm not a record keeper. I am an advisor, and there are, in my opinion, different levels of advisors in retirement plans. There are advisors who specialize in retirement plans, and there are advisors who kind of have a couple of retirement plan clients. I'm more of the specialist, but I'm also the first person, and I'm a fiduciary, but I'm the first person to also say, that's a question for your administrator. That's a question for your record keeper. So I want to make sure that we put it in the proper context. I'm not going to be the admin expert or all of the ERISA expert, but these are the, in this presentation, concepts that I think are important for businesses to know right now, and they're the concepts that I'm taking to my clients where I'm the advisor on their retirement plan. So I'll put that in context. Alicia, go ahead to the next slide. Awesome. All right, so in this presentation, I'm going to cover a whole bunch of different topics from unintended plan terminations to loans, the new loan provisions, the corona distributions, corona related distributions, CRDs, rules. But this first slide is reflective of the payroll protection program. And a lot of businesses, a lot of my business clients, just had a call earlier today with a client of mine in Virginia that applied for a PPP loan. They got it. And in the call today, they said to me, we don't know whether we need it or not. We kind of feel like we've gotten approved for this money, and we don't know whether we should use it or we shouldn't use it. And I think that that's a real conundrum for a lot of businesses right now. We were diligent because we wanted to make sure that if we got into difficult circumstances, we had resources. We don't know what the unknown is. We don't know when the economy will reopen. And so when the federal government is trying to help businesses survive and help employees continue to be employed, applying for the PPP is a responsible thing for any CFO, any business leader to do. So the PPP program and 401ks or retirement plans, it has a context, and it's basically, and we get this from a lot of businesses, can I use my PPP money for retirement plan contributions? And that's what this slide really addresses. It basically says that the payroll protection money can be forgiven for payroll, but also other expenses, including health insurance, retirement contributions, mortgage rents, and utilities. Okay, and so this says last week the Treasury clarified, but several weeks ago the Treasury clarified that that includes employer contributions such as match, safe harbor contributions, discretionary profit sharing. There isn't a cap on what can go into those different elements of retirement plan contributions. So so it's not like salary limitations. If we had a big amount of safe harbor contributions or profit sharing that we felt like we had to make those contributions because we were required to, we can do it, and we don't have limitations on the amount. But the last point is basically, in order to maximize the availability of loans to participants through loan participation, employers should be prepared to make some form of a deposit if they're going to use the money for a retirement plan in the 8-week period, because that's the eight weeks is when these PPP dollars have to be used from the date that the loan has been approved. So so it would be a good idea if you're looking, if you've gotten approved for the PPP and you may or may not be using all of the assets or all of the money for payroll. If you look at retirement plans, you may say, well, this would be beneficial because we were going to suspend our safe harbor contribution, we were going to amend our plan, or we were going to not make our discretionary match. These are dollars that can be used specifically for that. So that's an interesting attribute to the PPP. Alicia, next slide. This is filing extensions, and I think that most of us know that basically our personal taxes now we don't have to do until the, the night of July 14th. We don't have to complete our taxes. Just joking. But they've extended tax returns, so employers have an automatic extension to make their 2019 plan contributions that would have been due on April 15th to July 15th. That includes IRS SEPs, other retirement plans, defined contribution plans, money purchase plans, and tax returns can be extended beyond July 15th if you file for an extension. That's true personally and corporately. Excuse me. Additional time is being made available to make plan contributions for 2019 that can allow business owners to preserve capital on their balance sheets to pay tax bills. And so that's basically that slide is extensions. And yeah, so I mean, I think that that's beneficial because funding is one of the difficult decisions that people have right now with retirement plans. Go ahead, Alicia. This is a big question that I've gotten from many of my plans. Back in 2008, 2009, the Obama administration gave an exception for funding safe harbor plans, which was a good idea. Safe harbor plans, we have to file, we have to give notice to our participants by November 15th of the prior year that we're going to be a safe harbor plan for the next year. And you all probably know a safe harbor plan is a retirement plan that has traditionally a match that is dollar for dollar to 3% and 50 cents on the dollar to 5% of pay. That matching arrangement takes away some of the testing that is detrimental at times to highly compensated people at an employer or the owners of companies. And so a lot of employer plans in the marketplace have that same basic safe harbor type of contribution or matching, 50 cents, dollar for dollar, and then 50 cents. In fact, a lot of employers will say to me, well, isn't that the standard match? You know, when we're setting up a plan or evaluating, redesigning a plan, and it really isn't the standard match. It's the safe harbor match. The most common match in retirement plans is actually 50 cents to 6. But safe harbor gives a whole bunch of safety to business owners. It standardizes the plan, it simplifies the plan, it eliminates some basic tests, but it requires notifications. So 11/15 of 2019, every employee should have gotten a notice in a safe harbor plan saying, hey, for the year 2020, we're going to be a safe harbor plan. When what that means is the employer is committed for the entire of 2020 to do that matching regime. And now we're in this pandemic, and employers are saying, geez, I cannot even contemplate doing that match, but you're committed to it. And so basically what the rules allow you to do, so at the bottom of the slide, you can elect to discontinue your safe harbor during the year 2020, and that's fine, but there are ramifications to suspending your safe harbor, which is you have to give notice to everybody that you're going to do it. You have to amend your plan document, so you got to go back to your third-party administrator or your record keeper and say we have to amend because we said we were a safe harbor, but we're not. You're also then going to be subject to testing that's going to have to be done that year, so that's a cost. Amendment's a cost, testing's an additional cost. And so those are important things to recognize. You might also have what are referred to as corrective distributions in that year if you have highly compensated people or owners that all of a sudden are subject to discrimination testing and they can't defer as much as they used to. This might be a year where they over contribute and our non-highly compensated people don't contribute as much. And top-heavy plans, there's a whole other thing. Top-heavy plans might have a mandatory contribution that's required for the next year. So stopping being a safe harbor, you can do it, but you got to know that there are ramifications associated with it. The top part of the slide is basically what you can do without losing the safe harbor protection. So plans can discontinue making per payroll safe harbor contributions, but they have to make sure that they make contributions in line with DOL rules, which means they have to continue to make them at least on the quarter They can also do what a lot of I have 2 retirement plans that I work with where they do their safe harbor contributions in the next year, which employees, just in my professional opinion, employees don't really like that, because most people, when you put a dollar in the plan, they want to see the dollar match up in the plan. Some employers determine that they're going to wait all year, and then before March, they're going to make the contribution. So you have the ability to modify how your safe harbor contribution is actually contributed. Further extensions are available as late as December 31st of 2021. And you can still get safe harbor protection, but not deduct for 2020 if you didn't make the contribution. So that's basically the safe harbor stuff. You have the ability to make modifications, but if you step away from actually being a safe harbor, recognize that there are going to be some ramifications. There will be a plan amendment and notification that has to be made. Next slide. This is a big one too. I have, and this is partial plan termination vesting. So right as the world was careening in a bad direction and we were shutting everything down, I reached out to a lot of my employers and I said, just so you know, if you terminate 20% of your people, you have a partial plan termination. And then that's not the end of the world, but it's an important thing to recognize. And basically it's, if you have more than 20% turnover in 1 year, you have what's referred to as a partial plan termination. And there are a whole bunch more rules than are on this slide around partial plan termination. Circumstances can impact it, and retirees may or may not be counted. There are lots of things that go into partial plan terminations. The downside of a partial plan termination is that the people who have been terminated become 100% vested in their accounts. So, and that's, you know, not the end of the world, but if I have 5 people who are being terminated, and of those 5 people, let's say there's $50,000 worth of unvested account balances, employer match that wasn't a safe harbor that was subject to vesting, or profit sharing that was subject to vesting. If we have a partial plan termination, they 100% vest in those dollars. So we don't have forfeitures. Those dollars aren't subject to vesting. They are their money, and they can move them out of the plan because it fulfilled, if the plan had more than 20% of the population terminated. So just an important thing to recognize. If a plan, an employer, like I was talking to a client of mine the other day, and they were saying, you know, is this an issue? And I said, you don't have a vesting schedule. It doesn't matter. It's not a big deal. So it's not that big of a deal. There might be at the end of the year a minor filing that has to be done to make sure that the Department of Labor knows that it was a partial plan termination. But I don't think, other than in plans where there's vesting, that it's that big of a deal. But it should be paid attention to when we're laying people off. So next slide. Okay, so CRDs and then loans are really 2 of the bigger things that are coming out of this CARES Act. Okay, so CRDs are Corona-related distributions. And this is a big deal. I actually was talking to a client yesterday, and I was saying, you know, I've been hearing on the radio, because I listen to different AM radio stations, an advertisement for asking people, if you're eligible for a CRD, take your money out of the retirement plan and invest it in this other thing that we sell, kind of thing. And that's a very interesting concept, considering that this is really emergency provisions that are being offered by the federal government. Just like when the California fires hit, they had relief for people in California to allow them to have greater access to retirement plans and mitigate or eliminate or reduce penalties and all that kind of stuff. That's all that they're doing here. And it's important that people put it in the context of the CARES Act and COVID. So it's separate from a traditional hardship withdrawal. It's a temporary loosening of distribution restrictions. It's not permanently attaching to the plan hardship provisions. And so those are all important things. That's in the first bullet point. It allows access to all money types that people are permitted to have in a retirement plan based on their eligibility. And it creates a tax filing opportunity for a COVID qualified individual. And that's the next slide. We're going to talk about what a qualified individual is. It's basically available on all of the different types of plans, 401ks, 403bs, 457s, and a plan sponsor doesn't really have to adopt the provision for CRD, corona-related distribution. But if somebody took one and you were aware of it, you would want to amend your plan by December 31st, 2022. So it's not mandatory. I have several retirement plans with Fidelity, and they were, and I'm trying to think of some of the other, Transamerica, I think, where they just basically said, we're across the board, we're adopting these into plans. I don't think there's a reason not to adopt it into a plan, but if you didn't adopt it in your plan and nobody used the provisions, you wouldn't have had to have amended your plan or adopted it. But if somebody, on the chance that somebody did use a CRD and you didn't adopt it, then we'd have a problem. And so if you don't adopt it and then ultimately you find out that somebody did, I would say it's incumbent upon you as a good steward for your participants to adopt the CARES Act provisions by December 31st, 2022. You can flip to the next slide. A qualified COVID individual is a big consideration. It's basically, you know, basically what a CRD is allowing people to do is take a distribution of their account that isn't a hardship. It's just basically, I need money out of my account and I can take the distribution and not have to pay taxes and penalty on it when I take the distribution. The only way that that actually applies is if you qualify as an individual who's eligible. And that eligibility is up to you to certify. So as the individual, it's not up to the employer, it's up to the individual to certify that they qualify. Qualified person is somebody who, a participant, his spouse or dependent, has been diagnosed with having COVID-19 by a CDC approved test. And that's a big deal. So if you don't qualify that way, I would hope that you qualify the second way, which is financial consequences that are adverse from being quarantined, furloughed, laid off, work hours reduced. You're unable to work due to lack of childcare. You're a business owner or operator operators who close or suffer a reduction of hours, or other factors that are probably in the code. But so I think you could make an argument that a lot of us are impacted by the second section. The people who are actually diagnosed in the first section, that's a big one. If you actually were diagnosed and you have a CDC approved test that shows it, you do qualify. Now the other question is, you know, do I need the money? Do I really want to take the money out of the retirement plan? Do I want to take a distribution? But I know personally that I have other associates of mine that are being impacted by the inability to work and because of childcare issues with their kids. Now they are 42 years old and they have 3 kids at home under the age of 7. That's a difficulty. So if you have difficulty paying your bills because you have difficulty doing any kind of work because you have to take care of children, that would qualify. And so you would certify, and then you could utilize your retirement account if you needed it. No one wants to do that, but in these circumstances, if that's beneficial, then that definitely could be taken advantage of. Anyway, so down at the bottom it says no requirement there's no requirement for the plan sponsor to get documentation or to check that the participant meets the rules, and that's important. So the whole onus is on the participant. It's not on the employer. You don't even have to have a record of the fact that they qualify. It's up to the participant. And that in and of itself, if I were a participant, I would want to make sure that I had some real evidence of specifically how I qualified. And as the HR manager or the CFO, you might want to say to a participant, hey, this is a thing, and I know that you can do it, and I know you need the money, but could you do me a favor, do yourself a favor, because you have 3 years to pay this thing back, and you never know what's going to happen over the next 3 years. So if you do this and you don't pay it back over the next 3 years, and you owe the taxes that were due on it, and let's say that you never really qualified to have access to this in the first place, this could be a whole bunch of problems. So let's get some real validation, certification that you actually do qualify, keep it on record, because we don't want to run awry at the IRS. So next slide. Okay. And so this basically is saying that CRDs must be distributed on or after January of this year. I don't think anybody was prepared to do a CRD anytime before March, and before December 31st of 2020. So the COVID access distribution period is up until December 31st, 2020. Qualified individuals can treat distributions already taken in the year prior to March 27th as CRD distributions. So if you took a distribution during this year, you may want to, if it was before March 27th, the participant may want to identify how they certify that they actually needed to take the distribution. Maybe it was March 15th and we were pre-shutdown, but they were financially injured. They want to certify and kind of keep on record that that was a CRD. Defaulted loans can also be treated as COVID-related distributions for qualified individuals. So if you default on a loan because of financial impact or diagnosis, then that qualifies. The maximum amount that you can take is $100,000. It can be taken in one lump sum or multiple withdrawals, but it all has to be out before December 31st of 2020. The 10% penalty for early distributions under 59.5 does not apply. There are other different withholding rules that there's a 20% mandatory federal withholding that was installed during the first Bush presidential years. That doesn't apply when you're taking one of these distributions. They refer to a 10% withholding on distributions. I'm not really familiar with the 10% withholding on distributions, on regular hardship distributions in retirement plans. Maybe that's a mandatory minimum federal income tax that has to be taken out of distributions. I don't process all those guys. I'm not an administrator, but that can also be waived. But there will be notification that ultimately has to be made, but right at the bottom it says no requirement to provide a notice, but there is a special notice for participants to opt out of withholding, which is a Form W-4P. So there is a form that kind of goes along with the distribution request that says that it's, I don't want to have withholding, it's Form W-4P. But in general, you could take up to $100,000 out of multiple plans. But if you have multiple plans, you can't take more than $100,000 out, and you won't be subject to the penalty and the 20% mandatory income tax withholding. Go ahead. This is the cool part, that the CRD can be repaid back into the retirement plan over a 3-year period of time. The 3-year period of time begins on or after the date the CRD is received. So if you got one by September, then you would have 3 years from September to repay it. Only the amount that you get has to be repaid. You don't have to repay any kind of earnings on the money, lost earnings or anything like that. So it's just the amount that has to be paid. It can be paid in multiple payments or in one lump sum. You can pay it back in installments in 1/3 every year. I assume that people ultimately are going to probably seek to repay it all in the last year because that's generally, I think, how people do things. I think that's the biggest risk associated with this distribution, is that it's not a forgiveness of the taxes on the distribution. It's a forgiveness on the taxes on the distribution that isn't repaid. So repaying it is a part of the distribution. So you can spread the payment of taxes on the CRD over a 3-year period of time, or you can repay it over a 3-year period of time. So that's another way to look at it. every year over the 3-year period of time, you could take a third of the distribution and add it to your tax return. So if we took 50,000, let's do something easier, 60,000 bucks. I could take $20,000 this year and throw it on my tax return, 20,000 the next year, throw it on my tax return, 20,000 the next year, and I'd have paid the taxes on that over that 3-year period of time versus if I took the whole 60,000 in 1 year. So if you roll it back in at the end of the 3rd year, participant will have to file an amended tax return to recoup payments for the first 2 years of tax payments. So that's another thing. If you do it all in the last year, you can still break it down over the 3 prior years. So that's beneficial as well. Again, I'm not an accountant. It's outside of my area of expertise, but there are benefits to in the tax code to repayment. Just the important aspect of it would be that the taxes do have to be paid. And that's important. So you can take the distribution today, you can use the money today, and then you have 3 years to pay the taxes. Next slide. And this is just a simple comparison of the regular hardship rules in plans versus CRD. And so the regular hardship rules that you've written into the adoption agreement of your retirement plan, they're going to remain in the retirement plan the way that they currently are. This CRD is an emergency provision that's being thrown into the retirement plan. And so right now, there are retirement plans that I work with that don't have hardship provisions. So even if if there are no hardship provisions in the plan, the CRD can apply. Again, you'd have to amend the plan by December 31st, 2022. If anybody uses it, it's only available to qualified individuals, but this is interesting. They can be active, terminated, or on furlough to utilize it. Not subject to the 10% penalty, which is a big deal. Taxable and subject to federal withholding. Now this is saying it's subject to the 10% rate, could apply. I think that there's the potential for a waiver of any taxes on the distribution up front. You can spread the taxes over 3 years and you can self-certify, where a regular hardship is a lot more difficult. There are specific hardship provisions in different plans, and they vary from plan to plan. You're subject to the 10% penalty. You're subject to mandatory withholding. The taxes are due in the year that the hardship is made. There must be an approved hardship reason, and self-certification generally is not permitted. It requires documentation and approval. So I've had participants in retirement plans call me and say, I have to get my money out of the retirement plan because I'm going to jail, and I'm like, gosh, that's tough. That doesn't qualify as hardship, but why are you going to jail? Well, I owe the IRS money. Okay, so are you being foreclosed upon? Are you filing bankruptcy? Those kinds of things. And that specific participant, he told me that he owed $1,800 to the IRS. And I said, so what you want to do is you want to call the IRS and you want to negotiate a payment plan with them. And he said, oh, really? I'm like, and you're not going to jail. It's not a big deal. So hardships are a different reality than the CRD. And I think it's interesting that they're letting people self-certify, but it also, again, as I said before, it gives me a little bit of a concern because that's today. And then a couple of years from now, we've got the potential that they might be questioning people's certification. So as the employer, just make sure that when people say it to you, that there's actually, and it's likely that they have been impacted, just make sure that they have a record of it. Next slide. Basically, with regard to filing, there's no current code for these distributions. And ultimately, it's the responsibility of the taxpayer when their tax return is filed. They will probably have a new form 8915 that will be published to elect that's for for disaster relief that people can use. And we still don't have enough guidance on the 3-year tax treatment. And then this actually, although the 10% optional tax withholding can be waived, eventual taxes should be considered by the participant in the event rollover is unlikely. And so I think that that's, you know, the 10% withholding that I keep talking about for federal taxes, it might be beneficial for people up front to pay some taxes out of it, because there's a potential gotcha that could occur. Next slide. The other aspect of the CARES Act is this enhanced participant loan rules. And so current loan rules are basically, I can borrow 50% of my vested balance, usually with like a 5-year loan repayment amortization. And so if I have $40,000 in my account, I can only borrow $20,000, and I have 5 years to repay that with an interest component. Some of the vendors allow you to borrow money for a home and potentially finance that over a longer period of time. But what they've done with this COVID-related stuff is they've made it that you can borrow up to $100,000 and up to 100% of your account balance, which I think is pretty tricky kind of stuff. We don't want to default on loans in 401k plans, but it just so happens that there is actually a safe harbor in this for COVID-related defaulted loans. They recharacterize as COVID-related distributions, which is beneficial. But anyway, so that the $100,000 max, up to 100% of your balance, is the maximum for COVID-related stuff. That's reduced, that first bullet point there, that dollar cap is reduced by any outstanding loan balances in the last 12 months. So if I already paid back a $25,000 loan sometime earlier this year, I could only take of my account balance, if it was $100,000, I could only take $75,000 because it's reduced by that loan balance that was paid back in the last 12-month period of time. Increased limits are only for a limited period. Loans taken on or after March 27th, which was the date of the CARES Act, and no later than September 23rd. So, so that's an interesting thing for people to recognize is, again, I don't want to encourage people to take loans, but as September 23rd approaches, that this CARES Act loan provision will sunset. It's an optional provision. It doesn't have to be adopted into retirement plans, but if you had somebody who needed to take advantage of it, you'd have to amend the plan by December 31st, 2022. And I've had several employers say, well, I don't know that I want to adopt this. And I've basically said to them, you know, you got to be considerate of what's going on in your employees' lives. And should somebody need to get to 100% of their account balance, let's say that my account balance is $40,000 and I need as much money as I can possibly get. Under the traditional loan limits, I can only get $20,000 of that. And with the CARES Act provision, I get the whole $40,000. So that might be a very altruistic employer amendment. Go ahead and next slide. For COVID-19 qualified individuals, which is an important caveat, loan repayments due on or after March 27th through December 31st can be delayed for 1 year from the original due date. Okay, so there's a delay component in loans that are outstanding. The rule applies to existing loans in good order on March 27th. So you've been given the opportunity to delay loan repayment, and the same thing's true with new loans taken on or after that date. The interest continues to accrue, and the balance is stagnant, but the interest continues to accrue. And most of these loans, as I referenced before, have 5-year limits on them. This would extend the 5-year limit. It wouldn't be, I still have a hard stop at the end of 5 years. It would extend the 5-year limit. So that's beneficial. Next slide. This just speaks to general loan re-amortizations, of which I actually am a fan. When in plan documents, when we're rewriting or adopting or changing a plan adoption agreement, I like the idea of allowing people to re-amortize or refinance loans that they have, because interest rates change, circumstances change, and it would be beneficial for employees to have the ability to refinance their loan. Under regular circumstances, where there's a lapse of payments for leave of absence or reduced income, it doesn't allow the participant to meet the loan payments. They have one of two choices. They can make up all of the missed payments with their first paycheck and to continue the original repayment amortization, or they can re-amortize the loan for the remainder of a 5-year period. Again, that's kind of what I would recommend people do, is just refinance it, specifically now if we have such low interest rates. Most people choose the second option. Go ahead to the next slide, because this is, so the CARES Act has better options for people. Basically, people can forego their loan payments that are outstanding between March 27th and December 31st. And I don't know that some employers right now might already have this going on, where they're foregoing loan repayments. And I think that if you can make loan repayments, that's awesome. Never a good idea not to, but if you need to, because finances require it, you have until December 31st without default, but payments have to start after January 1st. There are, again, it's basically the two options, same two options. On January 1st, either repay the missing payments, but it's only interest that accrued. 2021 repayments must be based on the original loan amortization. So basically that could mean that you're doubling up during that period of time. Or option 2, which is probably what most people will do, which is re-amortize the outstanding loan balance. Interest that wasn't paid between now and December 31st has to be added to the loan balance. And then we refinance the whole thing and then extend it 5 years from that period of time, which I think we're going to probably see a whole bunch of that occurring, option 2. And I think that's great. And I think it's great for a couple of reasons. One is interest rates will be low. And I think that there are probably people out there that have had loans that had higher interest rates that probably should have been given the opportunity to refinance. But then 2, they have the opportunity between now and December 31st to have access to money that they would have used for loan payments to do other stuff with. So that's all good news. Next slide. Practical considerations of the loan versus CRD. The qualified individuals don't need to exhaust the loan options before they take their CRD, which I think is interesting. You're basically, as a participant, you're given, who qualifies, you're given the judgment of, well, which of these two would better suit me? Do I like the idea of doing a loan and repaying it over time, or would I rather just take the distribution and then pay the taxes over a 3-year period of time? Again, as a retirement plan expert and specialist, I don't want anybody doing that. I'd really prefer that people not tap these dollars, because it probably took many years for them to accumulate them, and it will take short order to distribute them. But I am privileged and I have a job and I can pay my bills, and I'm not in that circumstance. So if other people are in that circumstance, I think it's wonderful that they have the opportunity to access these dollars if they need to. The highlighted line, I highlighted this yesterday before I sent the slides to Alicia. You can take both. That's what's so interesting. So you could combine the distribution and the loan up to 100% of your account balance, up to $200,000. That's a big deal. The next bullet, the loan allows for a terminated employee to take an enhanced loan, but most loan programs do not permit this. The plan would need to be amended, including payment options outside of the payroll deduction, which is a common constant in retirement plans. We have people that have loans, but they no longer work here. Well, they have to pay the loan back, or the loan is going to come due, because we have to have a repayment structure. We have to have a way that that loan is going to be repaid. So if you have a terminated employee and they want to take a loan, there has to be some repayment option, some way to recapture the payment. So, and I would think that would be record keeper to record keeper. So John Hancock might handle it differently than Nationwide handles it. And so that would be an important thing to nail down with your record keeper before you said to a terminated former employee, okay, we have this loan option available to you. You have to know that. Normally, participants are encouraged to take a loan over distribution, but under the CARES Act, distributions may be more advantageous, and this was one of my big takeaways from this legislation. The loan extension ends January 1st of 2020. If you default on the loan in 2021, it'll be taxable in that 1 year. So this is a big gotcha potential for people who take the loan, and we don't know what economic circumstances are going to be in 2021. Hopefully we'll be having a booming economy and everything will be great, and one day we'll be able to pay all this money back and the air will be cleaner and we'll all be better off. But there's a potential that we don't see that, and so ultimately if somebody takes a loan and then in the year 2021 they default, they'll owe the taxes that are due on that loan in that 1 year, where if they had taken a CRD, they'd have 3 years to pay the taxes. And then the other one, which is really the last point, is the loan payments might actually be higher than people are prepared to pay. So if you borrowed $100,000 from your 401k plan because you didn't want to take a distribution, I mean, when those loan payments start on January 1st, if it's a 5-year loan re-amortization for $100,000, you might be talking $2,000 a month. So that's a big deal. Yeah, $1,800 a month. That's a lot. Go ahead with the next slide. And this is the last slide. So 2020 RMD waiver. This is a big deal. They already had done it in the Secure Act at the end of last year. They had taken required mandatory distributions for people that are 70 and a half and made the new distribution 72. But what they're doing now is during this year, there's no required mandatory distributions for anybody. And that, if you back into the logic effectively, it's required mandatory distributions that have to be taken from retirement plans are based on the 12/31 in this year, 12/31/2019 balance of your account, which would be really interesting for people if their accounts were 30% higher on 12/31 and now they have to take a distribution. So the government basically said, well, we don't want to back people and having to take some massive distribution out of an account that's already down 20 or 30% because the market is underperformed or had a bump. So no required mandatory distributions during this year. That includes people who hadn't done their first distribution once they turned 70 and a half that was due by April 1st of 2020. It includes a waiver for terminated employees or other owners still working who otherwise would have had to take an RMD. Let me see. Yeah, it says, but not RMDs from defined benefit plans or 457B government tax exempt plans. That's an important one. And then it also suspends it for 5 years post-death, RMDs on inherited IRAs. So that's just a thing to know that RMDs have been modified as well. So those are the basic things that I think were important. You know, when I was barraged by all of these different educational, every one of the record keepers was reaching out to me with their document that has all the Q&A and everything like that. And all of your record keepers, if you have a retirement plan with Fidelity versus Hancock versus Nationwide, they're all going to have different ways of handling it. Some of them have just said, we're implementing the rules and everybody can gain access to them and we'll amend plans. Others are leaving it up to the employers. So that was basically it. And that's all that I have at this point. So if you have questions, I know that my contact information is somewhere. If you have questions, you can email them to me. I may not have the answer for your plan, really, and I have a lot of this with my employer clients where I'll basically say to that, they'll reach out to me and I'll say, okay, let's get Fidelity on the phone, or let's get the record keeper on the phone. Or if you work with a local third-party administrator, there are great local third-party administrators. And for plans that haven't bundled it up with the record keeper, we work with those guys. I would highly recommend that you talk to your third-party administrator. But I would also encourage you, if you are working and you have an advisor on your retirement plan, this is a good time for you to engage your advisor with your participants in your retirement plan. I feel like these are the times when advisors should be kind of earning their salt, their pay. And so if you haven't heard from your advisor, I would reach out to your advisor and say, hey, maybe you could put together something to distribute to our participants, because your participants should know that although this is a difficult time, this market contraction, as far as an investment market contraction, isn't anywhere close to 2008. And we're blessed that our economy was gangbusters before this whole thing happened. And I think soon enough, I know you guys are in Virginia, so maybe mid-June or something, you'll open up, but soon enough, our economy will be chugging again. Alicia, we actually do have one question.
We do, yeah, I see it here. If an employee takes out a loan anticipating a hardship which doesn't come to pass, what happens when they can't show proof of hardship?
Yeah, so the loan is just a loan. So there's a lot in that question. It's basically, so are they doing a traditional loan? So you can go to your employer anytime and take a loan from the retirement plan. So if you just went to the loan and said, I'm going to take a loan from the 401k plan, that would be interesting, because you wouldn't have a loan repayment amortization. You'd have interest that's due on that loan, but the payments wouldn't have to start until January 1st. Okay, so traditional loan, and that is you can borrow 50% of your balance up to $50,000. If it was a CARES Act type of a loan, you could do the same exact thing, except those are up to 100% of your balance. So let's say my balance again is $50,000 and I borrow $50,000. That's when I have to certify that I qualified as an individual for a CARES Act type of a loan. Okay, and so that would be where my concern is that you have to, it's on you, it's incumbent on you as the participant to have some certification that you qualify under the CARES Act. And so if I did that right now, I don't know that I could show proof that I have been financially impacted. None of my family members are ill. If I went to my retirement plan and I took my balance is 50,000 and I took 50,000, I think that I potentially am putting myself in a sticky situation. I guess if they audited whether I qualified for that amount of loan, you know what I mean? If they qualify certification, I wouldn't recommend that to an individual. I would recommend that if you don't know whether you will have a hardship, that you try to stick with the traditional loans provisions. If you actually have some actual validation right now that you qualify, you might do it. And as the, September date for the end of actually taking advantage of these things comes to pass, you might really look at, am I having a hardship? Am I qualifying for this? That's kind of ultimately what I would do. But you do have time. And I was saying this to a business this morning who had filed for the PPP. One of my business clients, I may have said this already, one of my clients filed for the PPP and then were saying that they didn't know whether they needed it, and they felt like they felt kind of bad because they borrowed the money, but are we bad for taking the money? And I said, well, what I'm going to tell you is this. You could have been really diligent in doing that, and that's important because you have a whole bunch of people who work for you. And if you had gotten slammed in this thing, if you hadn't filed for it, then you would have failed your employees, okay? And so ultimately, if you don't use the money and you remit it back in the 8-week period of time, well, then that's good. You took care of your people. You didn't need it. That's a blessing. And that's the same thing here. I think we have to diligently look at it. And if we need it, we use it. If we don't need it, then we don't use it. The employee already took out the loan. They're asking for guidance. Will it just be defaulted? Should they try to pay it back partially? Okay, so that's the follow-up question. They already took out the loan. Will it be defaulted? So payments aren't due. The payment amortization doesn't start until January of next year, okay? On any loans right now, all loans can be suspended until January of next year. okay? Should they try to pay it back partially? I would say at this juncture, if they believe that they will have employment in 2021 and that they'll be able to repay it in the years that follow 2021, I wouldn't feel like it's incumbent upon them to make sure that they pay it back. If they want to turn it into a COVID-related default or distribution, then they might evaluate trying to do that during this year so that they can have preferential tax treatment over the next 3 years. So I would always kind of go back to, do they qualify for it under the CARES Act? If they qualify, if they're able to certify under the CARES Act that they qualify, and they feel like repaying it's going to be difficult, it might be beneficial to turn it into a distribution. That's my answer. I hope that was helpful.
Okay, wonderful. Thank you. That was a lot of information, a lot of helpful information. I think, you know, you provided so much of it that there aren't many more questions, and I think we're all trying to absorb it right now and looking forward to looking at the PowerPoint and reviewing all of it. So thank you again, Bradley, for all that incredibly helpful information. We really appreciate it. It's so timely and so helpful.
Thank you. I appreciate the opportunity. And again, if we can be of assistance, if I can be of assistance, Genevieve can be of assistance, you all know that we're here to help.
Awesome. Thank you so much. And then just before we finish up, just wanted to thank Ellen with BEI and Lila with the Reston Community Center again for supporting these webinars. And